Good morning, everybody. Eric here, 421. Brief market update. I just wanted to put out a video. I haven't done this in a bit. Hopefully keep this under 10 minutes, even 5, so you guys can watch it and just get a couple of thoughts. I want to address key issues like yesterday's negative oil price for May contracts. June is rolling over now. And, so look, my premise since back in, I think I started to send out to you guys the free e-letter list, my concerns about the market and some of the shorts that we had on very early in March, probably around the 7th to the 10th, if I recall, which was after we started to roll over and breach the moving averages on the S&P and the Dow. That's when we started to put hedges on. And those helped a lot. And we ended up, a little bit of what you have to understand, guys, just so you know, and I'm not saying this for you to join premium, but we're very active there and we do a lot more trades. And so sometimes for me to keep track of exactly what I told to elites, premium and elite and or the free e-letter, I can't exactly recall, and I'm doing this off the cuff, but I do know that we did talk about the shorts. I talked about the SPXU, and we didn't do anything with the VIX this time, I don't believe. But we also went long on things right at the bottom, right near the bottom in a capitulation period that looked very easy in terms of at least some sort of technical bounce. It was extremely stretched. And so a bounce was expected. The question for me is and was, how long does the bounce last? How far does it go? The first bounce I'm talking about. And my sense is that right now the markets are giving us a very merciful second opportunity to take a hard look at where you have your money before you could potentially get blown up. If you have retirement funds, IRAs, RRSPs, 401ks, in general, mutual funds, I'm talking about particularly U.S. domestic. This would apply, obviously, to things like emerging markets and everything, but those have already been way blown up already, even though, they'll get worse if we get worse. But I'm talking about general index exposure, meaning large cap, mid cap, small cap growth type of stuff, aggressive growth, funds, things of that nature that have just killed it for a decade, okay? That have seen your 401k and IRAs that you plugged away on during your work life increase in value considerably, okay? What I put out to friends on Facebook, and I believe that's what I shared here as well, back in early March was, this is going to get potentially very bad. And one of the things that you can do is you can consider and take a hard look at if you cannot afford a 50% or more decline in the value of your portfolio that does not recover for at least 3 to 5 years, you may want to consider taking anywhere from a quarter to a half of your exposure in equities to cash and or bonds. That's really what I had said. And it was mostly a petition for people that have, listen, if you're young, fine. But even if you're young, look, if I'm young, I don't really want to take that haircut on everything I've already built up anyways. So you can look at it that way because you're not retiring until you're very late in the game. But I'll tell you something, if you have cash, when things get destroyed and you have the mental wherewithal and the ability to take action contrary to what you're feeling, as well as the herds in general, and you can buy stuff for pennies on the dollar because you actually have cash versus worrying about your job, your income, and the fact that your life savings just went up poof in the air, it's a good feeling, okay? But it's not easy to do. So that was a precautionary message. And it wasn't one of like, look, get out, get short. I have no idea what everybody's particular individual situation is. So this is not individual investment advice. This is my general thought on the consensus of the market. So we're already at 5 minutes. I want to speed it up. I have increasingly in the last week, maybe even starting up to the Friday prior, started to put on slowly the short positions that I had on before as the S&P and the Dow and the NASDAQ and the Russell 2000 have inched their way back to their 50-day moving average. It's a ceiling now. That particular ceiling is a lot easier to break than the 200-day moving average, which is slightly above that level. We had what's called the death cross. The other, when it's going up, it's called the golden cross, and it's simply when the 50-day moving average goes up or below, above or below the 200-day moving average. It's just a signal that a trend is underway. It's not 100% perfect, but it is a fairly good and reliable measure to add into your overall assessment of things, especially technically. And so I have started to put that back on, and I was a little early on the S&P, so I'm down on that. SPXU is just the chosen vehicle that I have because I really don't need to. I'm not looking to hold these things for super long periods of time. I just want to make sure that I've got some action on if we either retest the lows, which a lot of that discussion has kind of gone out the window, which I think it makes a better case when you watch CNBC and everybody else. Initially, we were talking retest when everybody still felt the fear after the initial weak bounce. Now it's like, oh, well, the Fed is going to do everything they can. They've said they're going to print money to infinity, and it's going to cause another asset bubble, and onward we go. And that talk has faded. I'm just convinced that we're going to go to new lows in the indexes. I don't know if that's going to happen in the next 30 days or if it's going to take until the fall. But listen, things are not coming back like that. It's not going to happen. If you think it's going to happen, you're in denial. It's going to take time for this economy and the global economy to get back into a groove at all, much less show growth. Any year-on-year growth, if you had a hurdle rate from where we were Q4 last year, Q1 this year, forget about it. It's not going to happen for a while. When we restart the economy in earnest, there's going to be, I think, more validity to hope. But let's just talk about the Fed. So then why fight the Fed? I'm not fighting the Fed, and I've learned not to fight the Fed very much, except for everybody's talking about how we thought the same thing happened in 08, 09, and 10, and there was going to be inflation. So now the talk is deflation, inflation. What is happening now? It's deflationary activity. Okay, expected. Where's the inflation from all the money printing, and when is it going to come? Inflation is in and of itself a monetary phenomenon. And with all of the liquidity and money being printed, which, by the way, our government does not have any cash. They don't have assets. They have liabilities, and they're growing those liabilities by diluting more of our currency that they're looking at getting from us as taxpayers. And we're not going to be able to pay very much tax when 30% of the entire country is unemployed and getting money back. For the real unemployment rate, which is when you start to count the people that they don't think are looking for a job, I mean, we're already going to be approaching 50% of the nation soon that doesn't have a job. So all of this is, I call it fugazi. It's like a fugazi mirage. And that's why I'm a gold investor, because it's real money. And it is the one asset that everybody should have some of your savings in to protect the long-term purchasing power of the time and the energy and the work that you put in whenever that time frame was. Over time, gold has proven itself to maintain that purchasing power. Gold has acted extremely strong in the face of what has still been a strong US dollar. So if you're going to say, well, don't fight the Fed, buy stocks and assets and real estate and everything's going to go up, then you're going to only do that if there's inflation. And it's all going to be, you have to look at things in a real sense or a nominal sense, meaning what does the US dollar, the currency that we Americans earn our living in, what does that do over a particular year versus, say, the stock index? Say stocks and real estate go up by 10% and the dollar goes down by 17%. A real return is we lost 7% of our money. A nominal return is we made 17%. So in any event, at the end of the day, my thought on inflation and if and when that's going to kick in, it's not going to be an immediate thing. But remember this talk in 2010, 2011 about why we weren't seeing it then? There was no quote unquote velocity of money. It wasn't getting into the system. I think, and this is not a tech, I've got a lot of technical stuff and data that I'm putting together, but this is just my overall thought. Already in about 6 weeks, we've made the entire 2008 and 2009 scenario blush by how much liquidity has been pumped into this system. And it's not going to end up stopping anytime soon. The US federal government, from a fiscal and monetary level, are going to have to pump many more trillions of dollars into relief and liquidity in the system to avoid an actual depression with civil unrest. It's just what they're going to have to do because people will have a breaking point and it's probably not too far off into the future. In any event, I'm already 12 minutes in from a ramble, but today, in terms of action and what I am doing is I think that cash, so the US dollar, last thing I'll say about that is that there is a good argument for the fact that there is a shortage of US dollars in the system, meaning many nations, when they go into deficits and float debt, they do it in dollar denomination because we're the world reserve currency. So they have to pay that back in dollars and they pay interest in dollars and everything else, but a lot of their currencies are being destroyed. So they have to rush into the markets to raise dollars. Everybody was raising dollars in cash when we saw the crash in the market, when we saw gold pull back. It was a rush to cash. And initially I did some of that as well because cash is king in the short term in terms of the US dollar. Now, we could see the dollar. If the dollar goes higher and say we get a run, really a short squeeze, so to speak, type move, in the US dollar up to the 115, 120 area, it is going to be nasty. And our government and the globe will do everything possible to devalue that dollar. So the question is, does it rip first and really create a lot of major problems in the global system? I think it's probably going to stay fairly strong and it's going to have a run. But after that is when ultimately, all of this dilution of the currency will come home to roost and the dollar will weaken. The dollar has to weaken over time and the federal government wants it to. But we are in this position of the world currency, reserve currency, and the Fed may end up financing the globe. I mean, part of this recent package is that they were providing relief to other countries. So frankly, I think you need to have cash cushion. You have to have gold, physical gold, any physical gold exposure. I know the coins have and the bars have a big premium right now. I buy PHYS, which is the Sprott physical gold ETF. I'm a fan more than GLD. I know the gold's there. And it's trading at around par in terms of its net asset value. So you're not really paying a markup for the actual physical gold that is in the vaults. And then at some point, the premiums come down on gold and silver. I would swap the ETFs into the physical if that's what you're looking to do. But it's about having physical exposure to the gold spot price. Physical itself, coins, bars, obviously is the preferred method. But a mixture is fine if you want to put big money to work. PHYS is a good place to do that. And look, gold's down $30 today. It's still hanging in the 1600s. Any pullback is a gift. Gold is going, in my opinion, at least to $2,400 an ounce in 2020. That's my assessment. That's my call. Could be right, could be wrong, but that's where I believe that we're going. If we're not going there by the end of the year, we're going there in Q1 2021. That's about a 50% return from where we are today, which is huge, and it's safe. Gold is not going to go back to $500 in an environment like this with real rates declining, which are probably going to go negative in the United States, and particularly when an inflationary environment comes up. So the third thing would be make sure whatever exposure you have in your accounts to long-term growth equities, make sure you can handle a big drawdown, or you may want to add to your cash position, or even just grab more bonds. Go into a money market, a bond account, cash. I prefer cash over the bond market. There's not much upside there in my opinion, but in any event, if you go into shorter term T-bills, it's fine. And protect your savings, because right now we're going to have a test with oil going lower yesterday. I'll touch on this briefly. These are the futures contracts. The world is filling up. The storage facilities are filling up with oil and nobody wants it. There's no demand for it. So it literally went negative because they want to get it out of those storage tanks and are willing for they're paying people to take delivery in May. June's still trading around $17 a barrel, but I think it's probably going to go negative too. So if I were a futures trader, which I'm not, I would probably be shorting the June futures if I wouldn't have already started doing that yesterday, because I don't see a tremendous amount of demand for oil coming anytime soon, and OPEC's not going to crank their production down another 50% next week. I highly doubt it. Okay, so in any event, protect yourself. Defense is back on the table. We've had a rally back up to the moving averages. Where I would say I'm wrong and I would close my shorts and I will short more. It's very simple. I will short more gradually if the S&P and the indexes trade up towards their 200-day moving average, even a tad above that, which could be a bull trap. And I will have a core huge short position at that time, and then I will put a very tight stop loss on it from there. And based on where I've been buying recently, and these are 2 and 3x levered ETFs, it would be a hit. It would be a 20% hit. It might be, 15, it might be 25. I'm willing to do that because I also think that just on a retest, I'm going to make some really good money. And if we go to new lows, it's going to be very scary. And if you can make some money on the short side, you're more sophisticated. Now is the time that I would start some exposure there. But the big thing with this message is that went way over is it's back to defense. And this rally was a gift. And it's a great opportunity. It's a second chance to take a good hard look at making sure that you have enough cash, have enough savings, don't have too much equity exposure. Thinking that the last 10 years is going to be the same, the next 10 years is going to be the same as the last 10 years is not going to happen. The returns on equities is almost mathematically impossible. And if it does happen, it's because, what the best performing stock market in the world was the last 2 years? Venezuela. Because they have 1,000,000% inflation. Kids in the ghetto play with the boulevards and throw them around in the street because they're freaking worthless. We don't want that. Okay, and that's about the only way we're going to see, in my opinion, very, very new highs in equity and asset prices is because inflation is running rampant. It's not going to happen yet. We need a little time for that to get through the system, but it's probably coming. So be careful.